Hi everyone, welcome to our Lead Squad panel discussion. My name is Kartika and I will be your host for the day. I'm from Lead Squad's marketing team. So today we have a very exciting session where we will be discussing innovating insurance sales with technology. And before we get to the actual session, let me just quickly take the time to introduce our wonderful panel of speakers here. We have Mr. Mark Barrington, who is the head of strategy and insights at Holland. Thank you so much for joining us, Mark. Please tell us a bit about you, maybe a few lines for our audience to, get to know you a little better.
It's a pleasure. Thank you for having me. Yeah, so I've been at Hollard for a couple of years now, and it's interesting when you look back at your time over a career and how much has changed. And since my time there, I've created a lovely family of four. So my wife and two beautiful young children. And I have been at Hollard now for a little bit over a decade, having learned my way through the emerging and mass market insurance plays in South Africa. And I'm hoping to bring some of that through to the forum today.
Thank you so much, Mark. Happy to have you here. We
Thank
also
you.
have our next speaker here, who is Mr. Daryl Greater, who is the Chief Growth Officer at Discovery Insurance. Hi, Daryl. Thank you so much for joining us today. Please tell us a bit about you.
Hi, good afternoon, and thank you for having me. It's a pleasure and honor to speak to my esteemed panel and just to everyone on the call. We hope that I think the insights are valuable, add value to your professional sort of work circumstances and the decisions you make on a day-to-day basis. So I've been at Discovery around 11 years, just shy of 11 years, where I look after growth and distribution across the various channels for the non-life business. Before that, I was fortunate or unfortunate enough to have run claims and procurement, which are pretty high-touch, high-energy environments, as well as some various other roles, including sort of strategic initiatives, new business and product design, and some others. So I've been in the insurance industry around 17 years, I'd say, 17, 18 years, always on the non-life side. Before Discovery was at the First Rand Group, where I spent most of my career in the forensics area. And I think just as an intro, I'm incredibly proud to work in the insurance sector. It's a sector which adds real value to an economy. And without sounding fluffy, if you consider where would the world and an economy be without insurance, it would be a very different place. We hedge risk, we mitigate risk, we protect capital. And without insurance, nothing would work as it is that we take for granted today. There would be no construction, there would be no projects, there would be no importing, no exporting. Every bit of catastrophic events, from a weather perspective, would sit on a government fiscus, which, let's be frank, most government coffers cannot accommodate. And so, we really contribute to the economy and society in a real way as a sector. And for the insurance professionals on the call, you should be very proud of what you do on a day-to-day basis.
Thank you so much, Daryl. Yes, our next speaker joining us from Lead Squared is Miss Chantel Fraser. I know that a lot of you might have already seen Chantel in a lot of our webinars and roundtable discussions, but for the people who have joined us, fairly new, Chantel, please tell us a bit about you and your journey at Lead Squared.
Sure. So, I've been with Lead Squared now for, I think, just short of 4 years. Look after the African continent, and also incredibly honored to be able to work across a number of industries, insurance being one of my favorites. And there's so many things to get involved with, and so many opportunities to improve. That's a little bit about me.
Thank you so much. Well, we have a very, very wonderful panel of speakers. And of course, I'm very excited to learn and hear from all of them. But before we get to that, I have a few pointers to the audience as well. If you look to the right side corner of your screen, you will see a few options. The first one being polls, where we from the back end will publish a couple of polls during the panel discussion. And we'd love to hear your take on the several options that we've given. So that is that. The next one will be your go-to place for any questions that you want our speakers to answer, which is the question tab. So throughout the discussion, if you have any doubts, please do put it up over there and we can take them up probably towards the end of the session. And of course, the chat tab is where we can network. I can see a lot of you already networking with us. Good evening to everyone. And wherever you're joining from, thank you so much. We're very glad that you could make it. All right, so with that, I think I will hand the session over to Chantel. Thanks so much for joining once again. All right, I'll pop to the back end now. Thank you.
Thanks, Kartika. Daryl and Mark, thank you very much for joining us today. And to our audience, I'm sure Daryl and Mark will give us all a lot to think about. And we're really lucky to have these two very well-respected and just really nice guys with us at our Lead Squared Insurance webinar series today. As Kartika said, we will ensure we keep some time aside at the end of the discussion so you can ask Daryl and Mark any questions you may have. And also, please feel free, if you've got any thoughts that you'd like to share, we'd love to hear from you as well. And before we jump in, Daryl, a very big congratulations on your new role as Chief Growth Officer. You add so much value to the insurance industry, and we all wish you the very best in your new role. And for our audience, it's a pleasure. So sit back, relax, and enjoy. And it's time now to get into our discussion. So there's so many things I want to ask the two of you today, but let's start here. I think overall industry players have really shown tremendous resilience through some very trying times over the last 3 years. And it seems that in 2023, we're still going to have to deal with a lot of uncertainty. And so, Daryl, how do threats of recession, rising inflation, climate change, increasing interest rates, cyber attacks, etc., impact selling of insurance products?
It's a great question, Chantal, and actually very material, I think, to every financial services provider out there, and insurance is not spared. I think just with the intro to that question, it sounds a bit like a horror movie when you consider just the macro risk, right, surrounding not just consumers in their private capacity, but businesses as a whole. It's an extremely trying time. And I think what exacerbates it is, besides the risks of weather and cyber, etc., from a South African perspective, we've got structural challenges in the economy. You take the unemployment rate, depending on what source you use, is like 32.7%, I think was the last stat that I remembered. That's a massive amount of unemployment. That's people that have an inability to not just work, but purchase assets, contribute to the economy, pay tax. And that creates like a massive burden just on the ecosystem to start with. Then you just fast forward to the cost of living, inflation. I think depending on what you look at, year to date, calendar year to date for 2023, it's around 7%, 7.2%, far higher than before. But it's far higher for energy. Energy was sitting at 11%, food inflation 14%, and so I think the real impact on the consumer and the business entity out there is profound. Now, when you consider, I think, those impacts on disposable income, and again, everything I say is not just directed to a private household. I mean, it relates to a business too. Disposable income or available income for for a business. Disposable income is far less proportionately now than what it was a couple of years ago. With the rising interest rates, that hasn't helped. I think just in the South African context, you've seen about just under 4%. I think it was 375 basis points increase since end of 2021. So as a typical, homeowner who's bonded their house in South Africa, most people are sitting between a 5,000 and 10,000 rand extra payment on their bond. And you take a look at some of it's significant, and especially when you consider that against average income, right? And then you look at, companies that are leveraged with what they're paying on debt. So there's a lot more scrutiny on disposable income. There's a lot more scrutiny, therefore, on what expenses are paid against. And I think certain things, especially people that are responsible financially and risk averse, they know they need insurance. But now there's far more scrutiny on the value of the insurance that they have. And I think too often many consumers just look for a cheaper option because they see pressure and they just look for more affordable options, which is rational. but it isn't always long-term. It isn't always the best long-term decision, because generally cheaper insurance comes with less benefits, less payouts, higher costs when you do have to claim in terms of deductibles and excesses. And unfortunately, some people just don't get insurance, right? They just lapse their policy. On the South African side, 2/3 of all cars in South Africa are not insured. It's shocking, so you already got that pressure to start with. So I think just in terms of distributing insurance, there's a far more of an onus on a financial advisor or a broker or the person selling the product, if it's on a digital or a direct basis, in really reinforcing the value of insurance, even though it's a grudge purchase and people don't necessarily want to pay for it. But when you don't have it and the proverbial hits the fan, you're in a far worse off position financially. Many times you'll never recover. For a typical person in South Africa to write off a car of 200,000 Rand that's not insured with a liability claim if they've driven into someone, they'll spend a good 10, 15 years paying off their debt. They'll probably go insolvent, they'll have ITC issues, they'll never be able to take debt again. And frankly, a third of their life is ruined because of the financial struggle that they'll put themselves under. But that's not always topical when the consumers, when someone sits in their lounge with their spouse or their family, they're like, how do we make this budget work? So there's an onus on showing the value of insurance. I think now more important than ever is the value of advice. When capital is lean, there's not as much capital in the system as there was. When capital is lean and when disposable income is down, and with all the risks that you mentioned, I mean, add the weather. We've been in 3 years of La Nina, where we've had torrential weather in Southern Africa costing billions. You take the increase in load shedding because of our Eskom challenges and what that's done in power surge claims. I mean, it's cost the industry, again, billions. And by default, it's cost South Africans billions when they weren't insured, and they've got to replace their fridges and their TVs, etc. And you put all of that together, there's not enough money to self-fund, and there's actually not enough money or capital in the system for people to take out shallow covered insurance products. And so the value of advice is more relevant now than ever before, in my view. And I think it's definitely going to be a harder sell naturally, but I think the luck and success will favor the broker or the distributor of insurance that's able to showcase the value, why it's more important now than ever before, and also just to restructure risk protection adequately. Too often you still see a lazy attempt at a needs analysis based on a policy that was structured 4 or 5 years ago. Assets have changed. Sums insureds have changed. People's very risk profile has changed, and I think a needs analysis for a current insurance coverage program needs to be current. It needs to be recent. It needs to be done with detail, and that I think when you put all of that together, most consumers and most businesses with like half a brain, to be so frank, will realize you can't do without insurance.
No, that makes complete sense. And I mean, Mark, what is your view?
Yeah, I mean, I don't want to repeat a lot of what Daryl's already said, but I think to summarize some of that is there's no doubt that if you kind of rewind, let's call it 3 years to before COVID, right? We were in a difficult position already on a macroeconomic cycle. If you remember those days, I mean, it might feel like we were in a difficult place today, but already 2-3 years ago, we were in a tough spot where there was price inflation and affordability was a challenge and all of those types of things. Coming into COVID, however, kind of changed our mindsets, right? It made us forget, I think we've all been there and done that, in the fact that there's this kind of before COVID and after COVID kind of juncture point in our timeline. But if I look at kind of post-COVID, right, the time when that happened, we actually saw an increasing take-up of insurance, specifically on life insurance. And our thought processes on that is that the general consumer was overwhelmed by the idea of mortality at that space, right? People were seeing their loved ones, their family, their friend, all of those kind of things, sick in hospital, potentially, going through the worst of times. And we actually saw a short-term increase in the amount of sales that were coming through, just because people were more aware of it. Now, coming off the back of COVID, with all of the things that Daryl mentioned now, consumers are far more constrained. The premise of, there's a real risk to me having something go wrong in my life, in my lifestyle, has a little bit abated. It's now at the back of the mind. So we have seen people take the foot off the accelerator when it comes to insurance. Now, I think Daryl was alluding to it, but let me just draw it out in maybe a little bit more detail, is that insurance is there to help you in a time which you haven't necessarily expected to happen. Whether that be an accident in the car, which he was talking about, or if somebody, one of your loved ones, passes away and you need to plan for a financial future. The time at the moment when your finances are the most, constrained, when affordability is the time that potentially consumers can least afford to take a financial shock. So the idea of canceling insurance as being one of those grudge purchases, do I really need it? Can I kind of, get that out of my budget while I'm going through a difficult time, is one that could potentially have catastrophic impact on that consumer in the long-term lifestyle that they're living. So we have seen some downturn in kind of sales coming through there. However, we have seen people rationalizing their insurance landscape, meaning potentially they had multiple insurance policies. And what we've seen now is them consolidating and collapsing those, which means people are looking for better value. And I think that allows insurers to step into, can I call it, a void that has kind of really just existed because of the kind of, I guess, freely available and affordable consumer budget previously, where now it allows insurers to really say, well, what is the core basics that customers are looking for? And if we can get that from a single insurer, well, that's the insurer that I'm going to stick with. Let's cut out, just maybe even for the short to medium term, let's cut out all of those peripheral, nice to have benefits that have been sitting on those policies and just give us the core thing. What are we looking for? And we've seen some of that happen in our world, that sales of more of those basic elements of insurance have increased. Which, I guess every cloud has a silver lining. That's the one that we've definitely seen post the difficult situation that we're in at the moment.
Yeah, but that makes, it makes logical sense. Thanks for that, Mark and Daryl. I think we've also seen a continued trend when it comes to mergers and acquisitions. And so it appears that, all signs are showing that M&As will continue being a driver of transformation in the financial services sector. So, I think if I think of one of the M&As of late being Capital Legacy and Sanlam, it makes sense to me that Capital Legacy would want to leverage Sanlam's distribution capability. But, just taking this trend into account, Mark, what do you see, unfolding in the M&A space, and what are some of the pros and cons of going the M&A route?
Yeah, you're right, Chantal. There has been a lot of M&A activity in the market, some of that in the media, and maybe a whole lot more that hasn't necessarily made it into the media. So definitely something that we're seeing as a trend in the market at the moment. I think it's premised on a whole lot of different elements. So principally, why would M&A be happening? I think you've spoken about distribution opportunities within the Sanlam and Capital Legacy space. What we have also seen is a shift into partnering for capability or buying in capability. So when I talk about capability, I'm talking about across the entire landscape. Capability that could be as simple as a product. It could be access to a customer that maybe the acquiring organization hasn't necessarily had. It could be all the way down to the actual execution of that insurance value chain. So we have started to see more and more of that type of activity happening, where there are specialist and kind of unique skill sets across the value proposition, the value chain, meaning that the M&A activity is where organizations are seeing opportunity in the landscape, but they're going through this natural dilemma that happens about, are we going to be more effective in building that ourselves, or potentially backing the players that have been there, done that, and potentially walked the road already and learning those pretty difficult kind of journeys to get to where they are. So the M&A activity we're seeing is largely to accelerate those journeys, to potentially get hold of product that's in the market. So we're seeing a lot of M&A activity also in the UMA space, the specialist insurer lines, even partnering for customer bases and the likes. So to answer your question succinctly, Chantal, a lot of activity. I foresee that activity is going to continue into the future. From our side, in terms of Hollard, we are doing a lot of that through partnering to allow for benefit of bringing Insurtech, fintech related capability into the proposition, but not necessarily meaning that we're going to have to build that from the ground up. So hopefully the customer is able to get that on a quicker speed to market, and ultimately the broader ecosystem benefits from that type of activity.
Yeah, certainly sounds like exciting times. And Daryl, I mean, I'm sure you guys have been, have some activity around M&As or been working in that space. Is there something that you could share with us?
Yeah, so from a discovery perspective, we haven't done many acquisitions. We've always been quite deliberate to grow organically. I mean, we have done here some of there, but it's never been our core business model. But where we have been exposed to quite a bit of consolidation in the market is on the brokering side, within South Africa specifically. So if you take retail brokers, so I'm not talking your global and your specialist large national brokers like Marsh or Aon, I'm talking your retail brokers under 30, 40 million rand sort of books. Many of those types of brokers are under severe pressure for various reasons. So, for example, many retail brokers have been pushing pretty flat anniversary increases for a few years just to help their clients out. But with the impact of that was that commission and fees linked to portfolios wasn't growing at the same costs that the brokerage costs were going. And if you compound that after 5-6 years, there's pressure. Secondly, other costs, the cost of compliance, the cost of governance, professional indemnity insurance has been a bloodbath, and the cost of good PI cover costs a broker quite a bit of money these days. And I can go on, but the net result is there's quite a bit of expense pressure linked to income for many retail brokers. Secondly, from a brokering continuity perspective, South Africa has a stereotypically higher aged broker. I think in the one stat with the FIA, the typical broker was a 52-year-old individual. So these people over time are going to be reaching retirement age where they don't necessarily have that natural succession plan within their business. And many of these brokerages are family-owned businesses, and the children or the relatives within that family business haven't necessarily been brought into the business. They've studied something else, and it's not like this natural progression where the child takes over from them. And you take all of these points together. There's a lot more retail books that are available to be sold, and I think if you look at some of the larger brokerages, they've started like an acquisition strategy, and they're buying up these books in different types of transactions. It could be full equity, it could be partial equity with a transfer basis. But what that's happening is that now sort of medium to large brokers are becoming even bigger, and they've got more procurement muscle. They obviously have got a bit more leverage in the insurance market, which is good for their clients. And obviously then the broker that's selling the book either gets the equity out or they get a bit of an expense assistance, because most of these larger brokerages have links to administration solutions through binders, outsource, etc. And we've seen a lot of that happening, and I think it's actually going to accelerate, if anything else. So a lot of M&As on the brokering side within South Africa.
Well, that's really positive for the broker business itself. So when we look at from an inflation perspective, we've seen inflation, it's filtered through, and I guess we expect it to continue hitting a little bit harder in 2023. And I think you've alluded to it a little bit earlier, Daryl, but consumers need and want more cover. But I think what we're starting to see is that the cost to replace things like motor parts have increased significantly, and I don't have to go into the reasons for that, but which is in some cases resulted in transferring of these prices, resulting in increased premiums, but at the same time we see like narrowing of insurance cover. So I think when we talk about from a broker perspective, you've got brokers who are now looking for insurance coverage for their customers at a reasonable cost, but faced with potentially an unhappy customer, because of the cost involved. So, I mean, Daryl, how is this really impacting sales, and what approach should sales agents take? When I talk about sales agents, I'm speaking, to brokers or basically somebody selling insurance in the face-to-face channel. So what approach can the sales agents take when coming up against these objections from unhappy customers?
Yeah, so I think, frankly, there's a bit of work involved for the financial advisor. So firstly, they need to be aware of the market. It's difficult when you're faced with that objection or an unhappy client, but you're not exactly sure why the cost is going up. And too often it's easy to say, okay, I'll try to find you cheaper quotes. And then you get cheaper quotes. But generally that comes with inferior cover, which arguably isn't in the best interests of the client, and is the fiduciary duty of that broker then actually being demonstrated? Arguably not. So firstly, I think advisors need to know what is driving the cost of insurance, because frankly speaking, the cost of insurance will continue to go up for at least the next year or two, far higher than what it's been in years past. That's just a fact, and that's globally. And I think even if you just look at the financial results of the main South African players, I mean, I won't mention names, but go look at everyone who's released a financial result in their core retail markets and personal and commercial lines over the last 6 months. Most of them have made losses. If you strip out the direct businesses, if you strip out, the specialist business, you strip out credit guarantees and all of that stuff, on core personal and commercial business, motor properties, it's been a bloodbath globally. Some of the top 5 largest American insurers on their motor books made losses. And so insurance has to go up because, insurance cannot be loss making because it's a fund. And advisors need to be able to tell the client, have you ever considered what this fridge cost 2 years ago, what it costs now? Do the Google search, check the game website, the macro website, see for yourself what assets cost. You've mentioned motor parts, and motor parts was a big surprise, I think, for many insurers in the South African market. Motor parts went up about 14-15% in a 3-month cycle, very late last year. So I think, very, very early last year. Is when that cycle first started becoming quite evident. I'll give you an example. BMW X5, Chantal, not the brand new shape now, the one just before. So the model's ending, I think 2020 maybe. A headlight used to cost 22,000 Rand just for a headlight. And let's be honest, most accidents, there's a bumper, there's a headlight, there's a sensor. A BMW X5 on the current shape costs over 80,000 Rand per light. So yes, it's a facelift, but that just gives you a sense on the difference in costs. The same accident, arguably the same car, just a facelift version, but it's like 4 times the cost. And so when a client who has an X5 hears that, they understand a bit more. So there's definitely a knowledge, there's a knowledge gap that needs to be bridged, I think, by some advisors in informing their clients of that. Secondly, I think they I briefly mentioned, I don't want to echo what I said before, but they arguably need to do a proper risk analysis for that specific client, because clients will be happy to pay more when they know they're covered correctly versus a period where they weren't covered correctly. And if they're still on the same product and the same sums insured and the same structure that they were 5 years ago, currently they may have had an inflation increase on their sums insured on their property, but are they covered for the right risks? Do they have cover for power surge? Do they have cover for the necessary business interruptions that exist if they're a business? Do they have cover, for cyber, which has become so prevalent in South Africa? We're a top 3 hacked nation, individuals and businesses, together. So generally, when a client feels uneased because they realize that they've been exposed all along, and here comes the financial advisor, the broker, as a savior, providing this blanket of protection that gives them now that sense of comfort, they're generally more amicable to pay more money. And we see that play out, at least in some of the channels that we directly control. But that being said, there will be clients that simply cannot afford the insurance coverage that they used to have. And then there's an onus and a duty on the advisor to inform them, then this is your risk, and going forward, this is what you need to self-insure, self-fund. And then, there's going to be some clients that take the risk.
That makes sense. So, I mean, we can see clearly, so far, I mean, one of the key outputs here is education, into that sales force, and the sales force taking initiative to continuously educate themselves or stay up to speed rather. And I think just on another note, I mean, the insurance industry is transforming just so rapidly, and there continues to be new entrants into the market from, Insurtech businesses and digital first business models, which appear to be driving this trend of innovation to achieve higher profitability and perhaps reduced operational costs. And I always wonder, how sales agents in the face-to-face channel, so the brokers again, compete with these new channels. So, I'd be interested to hear from both of you in this regard, because I mean, Daryl, you're more on the short-term side, and Mark from a life perspective. So, Mark, how do you, what's your perspective here?
Yeah, Chantal, you're so right that the insurance landscape is disrupting almost on a daily basis, right? I mean, you've got entrants coming from the traditionals, right? So disrupting themselves. You've got kind of the small startups that are coming in. I mean, I can list 1,000 of them, but big ones at the moment are Naked Insure, Pineapple Insure, ClickSure, etc. You've got those type of players in there. You've got the telcos that are coming in that are predominantly a digital first offering when it comes to insurance, and all the way down to the banks and et cetera, et cetera. So there's definitely a kind of increased competition coming through, and that means that the consumer, the general and average consumer, is now kind of overwhelmed by all of this thing, and where do I go and what's the right way to me? I think each one of those offerings do offer a unique proposition to the specific niche of that customer segment. Like there is a customer segment out there that has a brand affinity to potentially their telco, to their bank, to et cetera, and that's going to be a standard piece. But by and large, the kind of average consumer, and I'm not just talking here about South Africa, but I think on an African continent perspective, is not fully playing in the digital landscape yet. What I mean by that is this is the time where there is a kind of sliver of people that are saying, great, if I can get digital first, I can do my full onboarding online. How do I do it? How do I swipe my little on and off tag about when I want my insurance to be on and off, which is great. For the moment, we are seeing that as about 1.3% of the total population, insurance population, that is going to be playing in that type of fully digital solution. There is, however, a significant part of the population, that by far the majority, that still want to have a warm body, a face-to-face, and I think to what Daryl was talking about earlier, somebody that can help guide them through the complex relationship that is insurance. What are the risks? What do I need to cover? What don't I need to cover? What do I need to do? All of those kinds of things. So yes, we are going to see some fragmentation of the market into some of these kind of more innovative and new entrants. But by far, the largest piece of the market is going to be less disrupted from a pull that channel out from under them, but more a case of how does the kind of transforming world that's happening get or enable that face-to-face consumer and face-to-face interaction. What I mean by that is the advisor that is helping the consumer to make the right decision is now starting to use the technology to enable a quicker, more efficient, more kind of informed conversation with that consumer, rather than getting rid of that advisor altogether. So there's this kind of blended model that we're starting to see coming into the world. And this works not only from a life perspective, but also into the short term, that you're getting this kind of, natural tension that's happening between all of these different face-to-face and virtual channels. We're seeing the future as not being just one of those, a blend of those, but how do we create this kind of omnipresence, omni-channel construct that allows for the face-to-face advisor to be supported by all of that tech that's sitting in the landscape.
And Daryl, in the short-term space?
So my side, it looks like my camera's frozen, so I'm hoping you can still see me, but I can hear
no,
you.
No, we can see you and you're moving.
Okay, perfect. So I think there's various aspects to answer this. Funny enough, many short-term insurance digital platforms globally have not yet broken even. So many of them are still dipping into corporate shareholding. for capital bailouts. Because, firstly, although there's this conception that the expenses will be lower because there's not like 1,000 people in a call center taking calls, etc. The infrastructure costs aren't cheap. The data management behind it isn't cheap. But the claims management, especially in certain societies where fraud, leakage is high, abuse is high, it's somewhat difficult to control claim spend efficiently when it's purely digital. And you've also got the cost of distribution, because if you don't have, like in South Africa, 12,000 brokers distributing a product, you've got to pay big money on above the line, right? And I think we all know what TV spend and billboards, etc. cost. So they're not necessarily. I mean, there haven't been a huge amount of Insurtech platforms, at least in the non-life space, that are printing money and showing decent margin, and that may change as they get scale and as they get better. However, I think we also need to consider that there can be that hybrid approach. So as an example, from Discovery, where I work, even though we were built off the back of an advisor across the life, health, insure business, invest business, etc., we're investing millions into digital enablement for advisors. Because you've got to bring the broker along the journey with you. Because let's be frank, most retail brokers, unless you're a global broker like Marsh, Aon, etc., you don't generally have a couple million sitting in your IT budget as a retail broker. So you've got to partner with an insurer that's digital savvy, that enables and allows access to that digital infrastructure to the broker, generally free of charge as a part of their broker contract, and just find ways to not just distribute but service the existing portfolios in a more cost-efficient way. And so that's kind of our strategy. I agree with Mark on many of the points. I think in certain societies, like if I fast forward 15 years from now, I think a lot of the standard sort of lower LSM mass market personalized business will go via a more direct or digitalized channel. I don't necessarily say that excludes the broker, because what you see is many brokers are investing in call centers, a direct strategy, as if they're a direct insurer, right? But I think there'll be a lot less brokers sitting in your lounge face-to-face for lower LSM business, because it's just too expensive to pay for the car and petrol for an 800 Rand policy a month. The commission and fees against that, the broker's going to go bankrupt. So there will be a more digital delivery there. I think in the non-life, the personal line space, your high net worth, space will continue to see face-to-face engagement, because like Mark alluded to, there's more complex asset structures. And frankly, your typical CEO who's worth 20, 30 doesn't have the time to sit on a telephone call for an hour and a half doing a needs analysis, right? He's got a risk manager, he's got a PA, etc., or someone's going to sit in his office after his boardroom meeting and run through the structure with him. And I think that will continue. But where I do think we'll see more digital penetration in the commercial space is now in the small commercial space. So I'm talking the plumber with 2 cars and a toolbox. I think, and we're seeing that already in markets like Australia, where there's a lot more digital penetration on commercial business in that SSME space, that very small commercial space, which is exciting, and I think it will be good to see how that plays out.
Yeah, and I mean there's such rapid changes in customer behavior. I mean, Mark made some points around just being aware of different things, before COVID, post COVID, and with all these rapid changes in customer behavior, and a lot of these customer expectations have been driven by tech advancements, where they want like increased accessibility, and it's becoming difficult. Not everybody is investing or has millions to invest into tech. It's becoming difficult for many insurers to keep up with the tech evolution. And we've certainly seen, that digital platforms and sales automation solutions have become vital to invest into, and many insurers are. So how can the investments, that are being made into digital platforms and sales automation solutions help insurers with, things like operational efficiencies, increased sales, and reductions in costs? I mean, Daryl, I don't know if you want to give that a go first.
Yeah, sure. So, look, it goes without saying, if you've got a good system behind you, you definitely have the ability to manage an operation better. Not necessarily lead it, but manage it better. assuming that people use systems as they should. I think we've all seen environments where you can have really, really good systems, but they're ineffectively deployed or trained or understood, and they add sort of little benefit to the business. But assuming a blue sky approach where you've got a good CRM, a good sort of sales pipeline management structure, where you've got good claim systems, by default you'll be running a leaner operation than a company that doesn't. We deploy, within some of my divisions, we deploy certain sales tracking and management CRM systems. And the ability, especially when it's linked to an app, when you've got your resource in the field, your business development manager in the field, who automatically has access to all active quotes done for brokers in his or her panel. And when they see the broker, they can mark that quote as, we're going to get it, not going to get it, need to work on it type thing. And it's real time. And you compound that over time, you definitely are far more aware and in control of your new business pipeline than a brokerage or an insurer that's sitting on Excel spreadsheets and trying to relook up different editions of quotes data. So and if you free up time, you free up capacity. And if you free up capacity, then your BDMs and your salespeople can speak to more people and create more opportunities. Sales isn't rocket science. It's about activity. It's about face time or opportunities that deliver quotes. And then based on conversion rates, you see the revenue, right? So the more activity per resource, by default, you're going to see a better revenue drive. And that also means that you have a reduction in cost in terms, because if you can see X clients with the same number of people with this infrastructure, you would need more people without the infrastructure. So there's that obvious reduction in costs. And the same thing goes with not just sales, with claims optimization. The Discovery Insure business where I work, years ago, we automated fast track claims digitally. So claims that take very little science to approve, very little underwriting, that generally many insurers still get a claim form, read it, print it, file it, and then, manually draft authorizations to the service provider. I'm talking windscreen claims. I'm talking geyser claims. If the premium's paid, like, you generally just pay that claim, right? It's not like you're going to do a massive validation. And for depending on your portfolio, that could be 30% of your claims. So for our clients, they can log a claim like that on the web or the app, and it's automatically approved if they've paid their premium and they aren't on some sort of red flag list, like they haven't had 5 claims the last month type thing, right? And that, if you take 30-40% of all your claims, and for us, we do 18,000 claims a month just on our non-life business, right? It's a big number. It's a big saving.
Yeah.
With a similar settlement ratio, it's not like people submit fraudulent windscreen claims all the time, where all of a sudden you've got this leakage. So it's a simple example, but your point is absolutely valid. Good tech, well understood, correctly deployed, integrated with the right partners, and if you've got the capital to do it, you definitely see the returns very, very quickly.
Yeah, and then I think a great point you made, Daryl, was making sure that it extends in a mobile version, to the sales guys out in the field. And, just off the back of that, so, client centricity and the expectation for, digitally enabled but personalized experience are still in high demand. But this makes it an ongoing task for insurers to continuously understand, their customer along every single touch point. So, Mark, how do you see sales automation technology assisting the insurers to achieve this so that they can maintain a culture of innovation and customer centricity?
Yeah, it's such an important point, Chantal, and just tying it back to kind of our opening statements where we spoke about, now is the time for us to double down on customer, actually understanding their specific needs, what are their unique kind of behavioral traits and the likes. I think coming into the new world, we've got a mantra that says that technology is not the what, it's the how. Let me expand on that a little bit more in the idea of, technology isn't just something that you say, oh, cool, there's AI, chat, GPT. Let's kind of take that. Where can we fit that into our business, right? I think you're setting yourself up for failure if that's your approach on kind of absorbing these new tech or digital offerings. I think you really have to understand what are the key pain points across your landscape. Potentially. I mean, and let's go with, the earlier conversation about onboarding of sales or customers in there. Okay, great. What are the new technology or innovations out there that if we can see a problem with, how do we do signature verification? What technology can help with that? Are there things that we can use to kind of leapfrog the kind of existing constructs that we've got? So, for example, in our world, we've historically in our fully underwritten life space, let me just take a step back and explain what that is. That's kind of us taking up 4 or 5 million rands worth of cover, and you probably need a drop of blood and that type of thing to really understand kind of who that consumer is and what their potential risks are. Historically, those types of policies could have taken anywhere up to about 45 days from the initial conversation to the actual kind of issuing of the documentation. And that's because it takes time for you to get, in front of the customer and to have the conversation and agree on what risks you've got, to taking the drop of blood, to getting it processed, to et cetera, et cetera. It's kind of quite a long process. What we, did is step back and say, surely there's a better way. The new world of data, the new world of kind of understanding actually who this customer is in their kind of intricate detail, doesn't need the same thinking that it had in the past. And nowadays, post quite a substantive change in our world, we can now onboard those people within less than 2 hours. And that's without taking a drop of blood, that's without doing any of those types of things. But an important point is we haven't increased the risk profile of our business in the process. It's not like we have now kind of short-circuited some of the tick boxes or at least the kind of the elements that were there in order to make sure that we were making sure that we were writing the right risk. And practically what that means, Chantal, is now the consumer is at the front of the headspace there, because what we're saying is like, surely we can't make a customer wait 45 days. How do we get that far more quickly in front of them and the likes? So we've done these type of innovations in a very customer-centric way. What is it that the customer is looking for? What are the pain points in order to deliver? How do we absorb the digital, the technology elements, as well as the innovations that are sitting broadly in the ecosystem to help support that? And I've given you an example of one of them. But front and center of the way that we should be approaching these digital kind of innovations is, what is it that the customer is looking for? How do we absorb those pieces in there in order to allow for it?
Yeah, that's a great example. Thanks for that, Mark. And on that note, I want to just talk about the customer buying journey for a moment. But look, full disclosure, I'm not a millennial. So perhaps that influences what I'm about to say. But I personally do not see the human interaction disappearing from the insurance industry. Brokers, I believe will remain, a crucial part of the buying process. But so is digital. And I don't see it, as you mentioned earlier, Mark, I don't see it being one or the other, but rather a mix of both. And I think that that insurers who can use sales automation technology to connect that human interaction with the digital experience will be the ones, who take the wins. And from my experience, just buying insurance, a month and a half ago, there's still a massive gap in this experience today. Like it's incredibly large. And I'm talking about, top insurance brands. Without mentioning any names. But Daryl, how do you think insurers can solve this gap?
So I think it also depends on, there's actually quite a few things. I mean, if I think about from a discovery perspective, our ability to really sweat our telematics technology has really helped us. So telematics 10, 15 years ago was not really something that was considered, known about, invested in. Telematics in the sort of North American markets and the European markets has got a lot more traction. But within South Africa, we were arguably the first insurer to grip it and scale it really, really quickly. I mean, 92% of all our clients, and we're approaching 400,000 drivers, have Vitality Drive on their platform, right? Which means that they have engaged and embarked on this program where telematics, which gives a score to their driving, not only unlocks like rewards and sort of the ability to give them monthly cashbacks, etc., but it also enables us the ability to design products, because telematics data is incredible when you just consider how different people drive, different demographics, different regions, etc. But more importantly, it brings like a digital element and a gamification element to a boring insurance platform. Because, insurance, like I said earlier, it's a grudge purchase. Psychologically, you don't feel good when you've got to pay for insurance. And generally, most insurers stereotypically only speak to their customers once a year when they give them a renewal letter, which means please pay us more, which again, doesn't always get taken well. And from a customer's perspective, you only really speak to your insurer when something bad has happened. So you're not in a good mood when you call your insurer, right? Like you've just had a hijacking, a fire, a claim, etc. So I think with things like telematics, it increases the touch points to the consumer a heck of a lot more. So for us, we speak to every client every week when we give them their weekly reward. And it sort of changes the psychological and the emotional sort of relationship between customer and insurer. It's not just like this one annual negative experience. Secondly, I guess, depending on who the company is globally, some of them give monthly rewards, annual rewards, etc. Again, that's a positive affirmation. But then like with us, with things like leaderboards, where you can compare your driving against your wife, or your husband, your boyfriend, your kids, your colleagues, and you compete
I don't know if
against
that's
each
a good
other,
idea.
and you rag each other. And it almost brings about that gamification, which is also important when it comes to digitalization and personalization. So all these key themes are enabled through telematics. It's just an example of, you can't just say, okay, I've got a good CRM. We don't run our data just off manual Excel spreadsheets, therefore we're digital. Like, I think it goes further.
Absolutely.
And I think, with things like telematics too, and that's why I think many insurers in South Africa now are starting to invest in a telematics arm. It's not their core business, but they're starting to dip more than their toe in the pond. It also enables a fast, like a sales journey. So for us, we've got a quote in 60 seconds. In 60 seconds on an online platform, a client can get a quote done. If you take some insurers, I think, Hollard once had a, pay as you drive sort of type product. Some of those are really successful overseas. Telematics enables that. So if you're a 22-year-old, bad insurance risk, stereotypically, right? But if you're a 22-year-old with a car, you don't necessarily have to pay the same rate that every 22-year-olds pay with telematics, because you could be a really good driver and you could be then end up paying the net result after your monthly cashback of what a 35-year-old pays. And again, that's like a really good experience for a client. But
and personalized,
exactly, it's personalized. But then I'd also go a step further to say, I think just in terms of making it easier for the customer and for customer centricity, you've also got to ensure at the very core that the product is relevant for the market, right? And I think if you just look at commercial lines for a second, Multimark has been the chassis of commercial lines products for the last 30 years. Multimark 1, 2, 3. But effectively, it's been the same product skeleton for 30, 40 years in South Africa. And arguably, many insurers have not really changed the core product in terms of benefits, but risk exposures have changed drastically. Like if you're a business in South Africa, your core risks are not fire, not only fire, or not only a weather pattern, but like two of the main reasons why you'll go out of business and go bankrupt. One of them is a business interruption of sorts, which is insurable, right? Secondly, reputational damage is a top 5 reason why businesses fail in South Africa. I'm talking in the SME space. Now, reputation management and all of that and crisis management, those are insurable risks. Your core standard insurers who still work with a Multimark chassis for the last 30 years don't give that cover. Why not? Frankly, in my view, it's unacceptable, because risk protection should have kept up with risk exposures. So as a core, an insurer needs to ensure that they provide relevant and appropriate products. Personal lines, you can't just have one product and expect the broker to force fit it for every LSM and every demographic. You need like a high net worth product to a sort of very entry level, still core comprehensive cover to cater for that broad spectrum. If you expect your brokers to be loyal to you and have the ability to maximize their conversion rates with you, right? You've got to empower the broker, unless they've got their own product on a paper. So when you've got a core product that's relevant to the market and you underpin that with decent digital expertise and with additional, really, really good boosters like telematics or wearables or whatever the case may be, like in life insurance or health insurance, I think then you provide a very, very aggressive and very compelling ecosystem, which is far easier to sell. And again, it's personalized to the client, which for any marketers on the call, that's the 8th P of marketing, right? There's no longer 4 Ps in the marketing mix.
No, thanks, Daryl. look, I just want to make sure I leave a couple of minutes for the audience to ask some questions. But before we do that, consumers are going through some, uncertain times, and there's financial, pressure, etc. But I really think that there is a great opportunity for brokers and, the sales agents out in the field during these times of uncertainty to connect with their customers, right? They are ideally positioned and skilled, and supported by, insurers like yourselves to help help consumers rebalance their portfolios rather than losing, that business in totality. But from what we see, being in the business of CRM, is that many sales agents still don't have a single view of a customer, in a simple to use CRM that is data driven. And I'm, alluding back to your points around the data points like telematics, etc. And so they miss out on so many opportunities to have these conversations, which obviously impacts retention. So we're talking a lot about sales, but what about, the holes in the bucket where we, that keep leaking? And before they can blink an eye, a customer has left. So I think there's always opportunities in uncertain times. But just quickly before we hand back over to Kartika, is Mark, how can sales automation help the brokers avoid missing these red flags, and improve, stop the leak?
Yeah, thanks, Chantal. Yeah, I'll try and give you a 30-second window to allow you time at the end of it.
Thank you.
Absolutely. I mean, I think, far too often as an industry, we're worried about filling the bucket, and there are lots of leaks to the bucket. So the idea of retaining consumers has to be front and center of our minds going forward. And I think that goes through not only just from a logical perspective, but also from a financial perspective. I think that data analytics and all of those elements can definitely be leveraged. And I think that we've already started to see a lot of those use cases coming through in our world about understanding who are customers that are potentially at risk of unaffordability, but potentially also leaving the organization. So some early warning triggers there to help kind of retain and keep those customers in and on the books. I think other pieces there is really about making sure that, to that earlier point, is how are we using, this broad construct of technology, CRM, all of these things, to make sure that the customer chooses you rather than their competitor. And the idea of kind of cutting down to the basics of what is it that a consumer needs? What is the product? What is the channel? How are they wanting to have that interaction, etc.? I think all of these pieces tie in a very unique balancing act, which is I think the nub of what you're asking.
Thanks, Mark. Yes, absolutely. That makes sense. So I'm going to quickly hand over to Kartika. So we got really carried away with our conversation, but Kartika, will you let us know if there's any questions for Mark and Daryl?
Yes, definitely. We actually have a couple of questions. Let me just quickly take that up. The first question is from Lindsay. She asks, you have touched on affordability in the last 3 years, pre and post COVID. But what has your experience been with regards to contactability pre and post COVID, and the challenge with load shedding, especially from a direct market perspective? Daryl, Mark, if you'd like to take that up.
Very quickly, I think contactability is more of a challenge now post-COVID. I think it became a challenge during COVID, right? When everyone was sitting 8 to 13 hours a day on a Zoom or a Teams call. And I think that trend hasn't changed, where people are a lot more just busier, right? And I think your typical direct call center type distribution channel isn't having the same hit ratio. So it's not having the same lead to quote ratio as probably that it used to have. And that's where you've got to have clever digital nudges, so whether that's SMS, webs, we find at Discovery, your web activity is highly effective, just in terms of how people navigate your web and request sort of quotes there. But I think, to answer your point, there's a material difference, I think, post-COVID on contactability.
All right. Mark, would you like to add something to that? Or?
No, I agree principally. I think that the day of single channel to contact a customer are over. And I think that that's what Daryl's suggesting, is you cannot just have a call center strategy that allows you to kind of outbound call. I think if that's your approach, you're kind of going to be spending money and not necessarily being able to kind of convert those leads anymore. I think you do have to take a multi-channel approach and kind of address the customer on all of those mechanisms.
Makes sense. Okay, Lindsay, I hope that answers the question. I'll just quickly take up another question. It is from Amani. I hope I'm pronouncing that right. From underwriting in claims to the customer journey and the distribution methods, what are the top insurance technology trends our team believes will be beneficial to carry into 2023?
Who do you want to answer this?
I don't mind starting it since you started the last one, Daryl. I mean, it's a complicated question, right? In the fact that there is no one tech platform or solution that is going to answer every need. I think, when it comes to developing a tech stack at the moment, the world of technology is moving so fast that backing a single platform is probably going to create a lot of legacy for you and the likes. I think our view is very much that we are moving our architecture into a much more of an agile architecture that allows for certain elements to be up or down weighted as we're going along. So if we believe, into 2023, collections, for example, is a really important part. We're able to scale the collections, and contact customer communication is much more kind of important for the moment. But going into the future, it's about how do we integrate the multiple channels to contact those customers. Then beyond that, it's about how do we use technology in order to kind of create dynamic pricing models to enable better product meeting the customer needs and the like. So I guess kind of a roundabout way of saying there are multiple elements that I think you need to think about. But if you're talking about one thing to do today around technology, it's about creating a technology stack that is able to be more agile to absorb these changing trends.
We're seeing.
Okay.
I was going to add on to that. We're seeing a lot. We're seeing that what Mark's saying coming through, on a daily basis, just by virtue of the number of integrations, systems we integrate into Lead Square to create, that front office operational platform, but it's powered by a number of different applications. So that makes complete sense. Okay, Katika?
Yeah. Yes, of course. Keeping the time in mind, Daryl, if you have nothing more to add to that question, I can just quickly take up the next one. All right, great. Okay, so before I go to the next question, a reminder to the audience, since we're reaching the end of our session as well, please do respond to all the polls that we have set up. We'd love to, kind of get your take on everything that we've asked. Okay, so coming to the last question on the panel now. The question goes like this: what insurance policies do you think are best to sell better on digital platforms rather than face-to-face interaction? Daryl, if you'd like to.
Yeah, so again, it's also quite a broad question. So generally something that's advice light, right? So you can't exactly sell a very complex risk protection, product on. Well, I mean, you can, but it's going to be clumsy if it's going to be digital. So I think if it's advice light, if it's a product that's underwritten by very, very few, underwriting factors. So if you think about funeral business, sort of those types of products, that's generally easier than a high net worth type personal lines product or a buildings combined and fire policy, right? But I think it also depends on just the richness of the product. So if you're an insurer that's got a really, really basic core product speaking to lower LSMs, really, really affordable premiums, versus a sort of A-graded insurer that speaks to a broader product, that's also gonna be material to the decision making. So and you've also got to consider what's digital. So is digital app? Is it via web? Is it an app journey? Because depending on what platform the user is interfacing with, you can also flex how light or how lengthy the journey is. So it's a bit of a broad question, Marwan, but thanks for that.
All right, thank you so much, Daryl. I think we've lost Mark. Okay, yeah, great. Yeah, sorry, Mark, we lost you for a second there. Mark, would you like to add something to it, or is it okay?
Katika, I think for the sake of time, I think that Daryl's touched on most of the points there. I think that's good.
All right. Okay, so with that, I think we have kind of come to the end of the session. It was truly wonderful. I learned a lot for sure. And I know for a fact that the audience did too, because of the number of emojis and questions coming in. I'm really glad that we could have this chat today. With by keeping the time in mind, I'll just quickly wrap the session up. So once again, thank you so much, Daryl and Mark, for taking the time out from your very busy schedule. And I'm really glad that you could join us today. And Chantel, of course, thank you so much for joining us and supporting us like always. And to the audience as well, we have more and more sessions coming up very soon. So keep an eye out for it, and we will see you soon. Thank you so much, everyone. Have a wonderful
Thank you, everybody.
Thank
everyone.
you. Take
Goodbye.
care.
Stay safe.
Bye. Bye.
Ciao.
Tuesday.
Thank
Bye.
you.